Super microcomputer nearly doubled revenue to $39 billion, but operations burned $6.8 billion in cash and debt exploded from $112 million to over $4 billion in a single year. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Super microcomputer gets graded and traded. So on the top line, revenue came in about 3% light of estimates, but the year-over-year number is what matters here. Revenue hit $11.1 billion, up 93% from $5.76 billion a year ago. That's a near doubling of the business. And on EPS, they crushed it. Non-GAAP earnings came in at $1.70 per share versus 41 cents a year ago. That's a plus 93% surprise against what analysts were looking for, and it's driven by a real operational improvement, not accounting noise. So on the beat itself, this earns a B. A slight revenue miss paired with a monster EPS beat gets you a strong grade, but not top marks. The mixed signal on the top line keeps this from being an A-tier beat, even with the earnings blowout. And on consistency, this earns a C. Super microcomputer has been an inconsistent reporter historically, with a mix of beats and misses over recent quarters, so I can't grade the track record higher than average here. Let's talk about the positives from the report. Revenue was up 93% year over year to $11.1 billion, and the full year came in at $39.1 billion, nearly double the prior year's $22 billion. That's not incremental growth. That's a business doubling in size. The margin story is the real headline, though. Gross margin snapped from 9.9% last quarter to 17.5% this quarter. That's an 800 percentage point jump in a single quarter, driven by a richer enterprise customer mix and adoption of their modular AI infrastructure architecture. And that flowed straight to the bottom line. Net income was up 504% year over year, and diluted EPS went from 31 cents to $1.62. That's a genuine profitability inflection, not a paper gain. Management also disclosed over $60 billion in new orders booked over the past year, and they're calling it a record backlog entering fiscal 2027. That's a concrete forward demand signal, not vague optimism. The forward guidance backs it up. They guided fiscal 2027 revenue to a range of $65 to $72 billion, which is 66 to 84% growth off the base they just posted. Aggressive, but backed by the backlog. So on profitability, this earns an A, driven by that near doubling of gross margin sequentially and a 500% jump in net income. When margins expand that hard alongside revenue nearly doubling, you're looking at a genuine operating leverage inflection. Now, let's talk about the negatives from the report. The full-year gross margin was 10.8%, which is actually down slightly from 11.1% the prior year. That Q4 jump to 17.5% is real, but it's 1 quarter old. Investors are being asked to underwrite that as the new run rate, and that's an unproven assumption. The cash flow picture is uglier than the earnings suggest. Operations used $6.8 billion in cash this year versus generating $1.66 billion the year before. That was driven by a $3.9 billion build in receivables and an $8.9 billion build in inventory. The growth is being funded by balance sheet expansion, not operating cash. Debt exploded to match. Credit lines and term loans went from $112 million in June 2025 to over $4 billion by June 2026, plus another $4.66 billion in convertible notes. Interest expense in Q4 more than tripled year over year to $80 million. And the biggest issue is right there in the press release. The board is running an independent review of certain transactions tied to export control issues, and the company explicitly warns the outcome could affect their forecasts, these preliminary results, and prior period results. That's a live restatement risk. On top of that, the financials themselves are labeled preliminary and unaudited. The release says closing procedures aren't complete and actual results may differ materially. So even the numbers we're grading here have an asterisk on them. On guidance, this lands at an A. The fiscal 2027 revenue guide of $65 to $72 billion is a genuine aggressive raise, implying growth of 66 to 84% off a base that already nearly doubled. Q1 guidance also stepped up meaningfully, so this is management leaning hard into the demand signal. And on red flags, I'm at a D. The export control investigation with disclosed restatement risk is the single biggest issue, and it stacks on top of preliminary unaudited financials and a balance sheet where growth is being funded by debt and working capital, not cash. This is a lot of risk sitting under a great-looking print. Putting it all together, this is a genuinely strong operational print sitting on top of a governance and balance sheet situation that keeps me cautious. The demand and margin numbers are the real deal. Record backlog, aggressive forward guide, and a margin inflection that flows straight to earnings. But the export control investigation with explicit restatement risk language, plus preliminary unaudited financials and $6.8 billion of cash burned into working capital, mean this print is tradable but not investable quality. Overall, I'm giving this print a B. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The setup here is weird because the demand numbers look great, but there's an active export control investigation that could force them to restate older results. I have to price both of those in at the same time. So my move is selling cash secured puts well below where the stock is trading, and I want to wait for that first day where implied volatility gets crushed after the report. That way I get paid to sit and wait. What I will not do is market buy shares into the guidance-driven pop. With a disclosed restatement risk hanging over the name, the asymmetry just does not favor chasing the spike. So for me, I'm selling cash secured puts and skipping the chase. The fiscal 2027 revenue guidance of $65 to $72 billion plus over $60 billion in new orders gives me a real fundamental floor. So strikes anchored around the pre-earnings price zone should hold up on business quality alone. My strike floor is the price I would genuinely be happy to take assignment at. Knowing an export control restatement is possible, that pushes me meaningfully out of the money, not right at the money where the fat premium lives. Even my most aggressive strike still leaves a margin of safety for a bad governance outcome. I won't sell a strike I wouldn't want to own shares at through a possible amended filing. So for me, strikes go deep out of the money, and I'm not chasing the premium. The demand story here is real. Record backlog, over $60 billion in new orders, and a fiscal 2027 guide of $65 to $72 billion. Plus, fourth quarter gross margin jumped to 17.5%, which is a genuine operational win. That all argues for holding through the print. But with a disclosed board investigation and preliminary unaudited numbers, I don't want to be maximally sized. So I'm trimming a piece of my position into this strength to respect that governance risk. I want to keep dry powder ready. If the investigation resolves cleanly, the underlying business trajectory is clearly accelerating, and I want room to add back. So for me, I'm holding my core and trimming a piece. The guidance-driven repricing probably pushed spot right through a lot of my pre-earnings covered call strikes. So now I'm choosing between letting them assign, rolling up, or rolling out. The fiscal 2027 guidance argues for rolling up rather than letting assign because the fundamental case actually improved, but I only roll to strikes that reflect the upgraded picture, not back to the old pre-earnings zone. Post-earnings implied volatility is elevated right now, and rolling into peak volatility means I'm selling calls at unfavorable terms. So I'm patient. I wait for that first day, where volatility compresses before I make the roll. So for me, I'm rolling up and waiting for the volatility crush. The multi-year backlog and the fiscal 2027 guidance extend the runway for my LEAPS thesis. So the LEAPS I already own actually have a stronger fundamental case than they did before earnings. But the export control investigation is a genuine threat to a LEAPS thesis. If they restate prior period results, that resets the entire multi-year growth narrative that a 12 to 24 month position depends on. So I'm holding what I have, but I'm not adding new LEAPS exposure until the investigation resolves. The asymmetry just does not favor starting fresh, long-dated risk into an open governance review. So for me, I'm holding my LEAPS and taking no new adds. The fourth quarter print really does validate the bull thesis. Record backlog over $60 billion in new orders, and gross margin jumping from 9.9% to 17.5%. That absolutely supports averaging down on a fundamental quality thesis. But the board investigation into export control transactions is a live risk that could invalidate the whole thesis. No amount of demand strength cancels that out. So if I'm adding, I'm sizing smaller than the operational numbers alone would justify. I want to save capital for a post-resolution add rather than putting my full add in right here. So for me, I'm adding smaller and saving capital for the resolution. Bottom line, this print earns a B from me. The demand and margin story is genuinely impressive, but the live board investigation and the balance sheet burn keep me from treating this as a full green light. Thanks for watching, and I'll see you on the next one.